Hello, I'm Tom Gosling, Professor in Practice at the London School of Economics and Executive Fellow at the European Corporate Governance Institute. I'm here with Professor Aswath Damodaran, Professor of Finance at New York University Stern School of Business, to discuss the topic of sustainable investing. Professor Damodaran is known as a Dean of Valuation because of his world-leading expertise in company valuation, corporate finance and financial markets. But our main interest in relation to this interview is his writing on ESG, sustainability and impact investing. Proudly self-identifying as a moral troglodyte on these topics, he's described ESG as an acronym born in sanctimony, nurtured in hypocrisy, and sold with sophistry. And his articles, The Siren Song of Sustainability, the Theocratic Trifecta's Third Leg, A Sounding Good or Doing Good, A Skeptical Look at ESG, and Good Intentions, Perverse Outcomes, The Impact of Impact Investing. I think these articles are, in my view, required reading for anyone involved in investing and in particular in sustainable investing. So Professor Damodaran, I'm delighted that you've taken time out of your busy schedule to speak to me today.
I'm glad to be here.
We'll touch on the arguments you make in a number of these articles during the interview. But if I may, I'd like to start off with your reactions to the series of articles that Harald Walkate and I put together for ECGI called Does Sustainable Investing Work? And we'll put a link to these articles in the show notes. But in brief, we analysed what needs to be true for sustainable investing to have impact on real world environmental and social outcomes. First, the activity needs to have some effect on companies. Second, companies need to respond to that effect by changing what they do. And third, those changes have to persist rather than being offset by the actions of competitors or other actors in the system. And when we reviewed the academic evidence, it suggested to us that conventional sustainable investing techniques really struggled to make it through all three phases, which led us to conclude that sustainable investors wanting to have an impact perhaps need to focus less on trying to achieve sustainability outcomes directly and more on influencing the circumstances in which those good outcomes can occur. But in terms of your reactions to our work, maybe let's start with, what did we get right?
No, I think your basic questions are right. I mean, those are the questions to ask. Because ultimately, I think one of my problems with the way impact investing in general, sustainable investing is part of it, has been measured is by how much money is invested in the space, which is to me a terrible way of measuring impact. Saying that you've invested 5 trillion in clean energy is not the same thing as showing that that investing is actually showing up as more clean energy as part of our energy requirements. So I think the first thing to do is frame the question correctly. Impact, if you're asking, does impact investing work? And the way you measure it is whether you make excess returns in your portfolio, you've lost the script. That's not the original idea of impact investing. But you'd be surprised at how, maybe you're not because you're familiar with the literature. Much of the literature on ESG and impact investing measures success by looking either at alphas, how much do investors make over and above what they could have made by not invest by a general investment strategy, or by how much money is spent in the space, rather than are we changing the world in ways that we said we were going to change, which is the original intention of all of this space. So I think in many ways, you're asking the right question, but unfortunately, you're more the exception than the rule in framing the question correctly.
Okay. And well, that's encouraging to hear. But what did we get wrong or underemphasize or perhaps just miss altogether in your view?
No, I don't think you do. I think in a sense, what's been missing in this space is honesty. Honesty in the sense of saying, look, if we want to make the world a better place and we're investing on that basis, we have to accept the fact that we have to give up something. The notion of good without sacrifice has always been a myth. So if you want one, you have to live with the other. And to me, that's the original sin in both ESG and sustainable investing, is because of the zeal to get it out there and get more people involved, people sold it as you can have your cake and eat it too. And I think your paper, in a sense, says you can't have both. You've got to decide what you're willing to give up in order to make the world a better place. And you've got to take your investors along for the ride. You can't do it behind the surfaces because it's other people's money. I run an endowment fund or a pension fund. I'm not investing my own money. And if I want to direct that money to sustainable investing, I've got to get buy-in. And I think if you're honest about it, I think you'll get the buy-in, perhaps not at the scale that you did in the last decade. And I think what destroyed ESG was the fact that too much money came to the space, drawn not by good intentions, but by the expectation that you could beat the market. That this was like value investing or some other growth investing strategy designed to beat the market.
So in that context, I'd like to come on to some of your writing on this topic, which I think is really interesting. And I'd like to start with the arguments that you lay out in your article, good intentions, perverse outcomes, the impact of impact investing. How do you characterize the different types of impact investing and how are they intended to improve the world in your view?
Much of impact investing, as we've seen it, at least in the last 2 decades, has been directed towards, clean energy and saving the planet. I mean, there are other reasons you can do impact investing, but social impact investing is far less than clean energy impact investing. So when I started that exploration of how much impact investing has done, over and over I came back to this point of, look how successful we've been in impact investing, how much money we've invested in clean energy, rather than saying, by making this investment, we've actually shifted energy usage away from fossil fuels to clean energy. And as you pointed out, when you put pressure on a subset of the players, which is what we're doing with ESG and sustainable investing, we're putting pressure on publicly traded companies, especially publicly traded companies in the US and Europe that are more, I think, exposed to that kind of pressure. So naturally, an ExxonMobil, and if you remember that famous win that Engine 5 got over ExxonMobil was, hey, look, guys, we can't take this stress. We're going to get out of fossil fuels or reduce our exposure, but we're going to do it by selling those fossil fuel reserves to private equity firms. So in that impact investing paper, I also looked at, hey, it's true publicly traded companies have shifted away from fossil fuels. But that investment is happening anyway, but now it's happening under the surface. And it's happening with some of the worst players in the game I would rather have ExxonMobil exploit my fossil fuel reserves than Carlyle do it. Because in a sense, ExxonMobil has some internal constraints that you can use to make sure it doesn't happen. So I think in that sense, I think impact investing kind of lost its way. The other thing I noted as I looked at impact investing is it's black and white. There's good investing and bad investing. Until Russia invaded Ukraine, nuclear energy was on the wrong side of the divide. So much as impact investing talked about clean energy, nobody wanted to talk about nuclear energy because it had been put on the wrong side of the divide. And I think by doing that, we've effectively reduced our chances to have the maximum impact with the money. There's a very interesting paper that Kelly Shue, who teaches at Northwestern, has written. You might be familiar with it.
Yeah.
That money invested in gray rather than in green has a bigger impact per dollar on carbonization and the planet than money invested in true green energy. I think by making this black and white, good and bad, we've kind of pushed away fossil fuel companies, coal mining companies into the bad column and effectively reduced our chance to make an impact with the same dollars, which is far greater than the impact you got by throwing all of that money to solar power and hydropower. I have nothing against it, but in a sense, by making it black and white, we've reduced our end game effect of, will this impact investing actually change the world?
And is that what you mean by the perverse consequences that you refer to in the title, or are there further perverse consequences?
The perverse consequences is by pushing publicly traded companies that are pressurable away from these bad energy sources. We've actually pushed that energy into the hands of people who have no sense of pressure on them. I mean, private equity invested, I think, $1.5 trillion in the last 15 years in fossil fuel. So it's not that, I remember a discussion of BHP wanting to get rid of its fossil fuel reserves because they wanted to score higher on ESG scores and look more sustainable. But the key was they sold those reserves into the hand of private equity investors who felt no qualms about developing the reserves. So I think in many ways, by doing what we've done, we feel good because we say, hey, we made the big publicly traded companies more conscious of carbonization and fossil fuel, but we've not had the impact on the ground in terms of shifting energy usage away from fossil fuels, because that energy is still being produced, but it's now being produced by people who are almost invisible players who you can't pressure because they're privately owned and they're privately funded.
I think we've touched on this issue already very briefly, but I'd like to dig into it a bit more, which is one very strong criticism you make of ESG and sustainability in general and impact investing is the fact that people always want to have their cake and eat it. And indeed, your taxonomy of impact investing approaches includes quite a lot of strategies where the adopters of those strategies would claim to be making a difference into the real world without accepting that this comes at the cost of reduced returns. And this win-win thinking has been pretty central to the so-called business case for sustainability. Why do you think that that is a flawed way to look at things?
Because if it were a win-win, we wouldn't need ESG and sustainability to get it along the way, right? If companies can actually make money by doing this, you wouldn't need an external force to push it along. If you could become more profitable, more valuable by being more sustainable, why do I need a sustainability guru telling me to do that? The very fact that you need that prodding tells me that it is not something. I know that there's always this escape hatch in the long term, but come on. I mean, the Keynesian response of in the long term we're dead is very, very relevant when you think about commercial and investing purposes. So the truth is, if it were connected to profitability and value, it would happen anyway. And I think it also it reflects something that human beings have known for. I mean, one of the things I wrote in one of my pieces was, if you look at the history of humanity and you look at whether it's easier to be good and easier to be bad, the answer is easy. It's easier to be bad. That's why religions have the Ten Commandments, because effectively they had to sell you on the notion that to be good you have to sacrifice. That's always been true. And what struck me as a false pitch when ESG went into high gear, and remember, this wasn't always true. In the early days of impact investing, people were actually very clear that if you did impact investing, you'd be giving up some returns. I remember the fund that was founded on Catholic principles in the 1990s. Now, I forget the name of the fund, but basically it was a fund for religious Catholics where it told them, look, we're going to invest based on Catholic principles. But if you do so, they were, in their prospectus, they said, we expect to earn less than the market. And I think they might put a number, 40 to 50 basis points less, but you'll go to heaven. And that's the trade-off they offered. Look, in the material world, you have to give up something. And even in the early days of ESG, I think there was this recognition that pushing companies to be green and to be good would cost them. But the salespeople took over. They realized that that pitch would mean that you had a fairly limited audience. It's a big enough audience. I mean, if you said, look, we'll go after the 20% of investors who really are willing to accept sacrifice in return for higher returns, this would be a much healthier discussion that we're having today. Then the push to make when BlackRock bought in, that should have been a sign for ESG and sustainability advocates that you'd lost the script. In what universe is Larry Fink thinking about the goodness of the world while he's pushing it? So once you get the big establishment players becoming part of the game, you know that you're going to lose control of the pitch. And that's what happened. Now, early on, they got lucky because of the focus on carbonization, carbon footprints. Now, ESG investing tended to be focused on tech companies without big physical assets. And the early part of the last decade, tech companies did really well. I call this accidental alpha, which is you have an alpha because you happen to be in the right place at the right time. It takes a while for this to catch up. I've seen a lot of research in sustainability and ESG making this claim that investing in this space will earn you higher returns. But if you dig a little deeper, it's almost always either sampling bias or accidental alpha, where you did something that happened to do well in the same period. It wasn't because of ESG and sustainability. It was because you happened to latch onto a sector for another reason, which went up for another reason, but you claim credit for it.
In that article, you look at the particular case of climate change and the influence that the various impact investing strategies of these different channels have had on the market prices of fossil fuels and renewable energy firms and on climate change overall. And overall, you seem to find that there probably are some price impacts from sustainable investing behavior. So it's not doing nothing, and therefore, presumably, some impacts on cost of capital, but they don't seem to be that large or that permanent. And it's not clear that they flow through to much real world change. Is that a fair summary? And if so, why do you think that's the case?
I think people forget how big the investment market is. It's trillions and trillions of dollars. So when you say I have $500 billion going into sustainable space, you don't recognize that in the market impact effect, it turns out to be almost rounding error, which is your cost of capital might get pushed from 7.9 to 7.88%, but it very quickly gets pushed back. And the reality is much of the investment world has a fiduciary responsibility. Most people are investing other people's money. They have a fiduciary responsibility. And if you have a fiduciary responsibility, it's very difficult to sustain investing in something if it's costing you money. That's why they developed the sales pitch. Because without the sales pitch that you could do good and be good at the same time, you couldn't have got pension funds and endowment funds to jump into this space. But the reality is, the minute that gets exposed as a lie, you have a fiduciary problem. In the US, this is manifesting in cases that have been filed against. I don't think the cases will go very far, but it's kind of a warning shot of if you do this and you deliver less than the market, you're now going to be exposed if you haven't brought along your investors for the ride. If you haven't told them, you haven't been open about what you did. So I think that much of the investment world, because of that fiduciary drive, you cannot accept an investment strategy that delivers less return because it's other people's money that you're investing. So if it's just individual investors, my guess is you could appeal to people's consciences and get them to move, but you don't have enough weight as individual investors to make that kind of impact long term in the market.
I'm sure you've not been short of feedback on your views on the topic of sustainable investing. And so, what are the main arguments that are thrown back at you, and how do you respond to them?
I think the biggest argument that gets thrown back is this is short term. You're being short term. I mean, we're 16 years into this space. At what point does the short term become the long term? I mean, the definition of insanity is you keep doing the same thing over and over again. This space strikes me as being full of doing the same thing over and over, expecting a different outcome. And I think when people say, just wait, in 10 years, you'll see the impact, I don't think so. I think that we have to accept the reality that there's something structurally wrong with the way we're approaching this process that needs to be changed. I'll be quite honest. One of the many things that 2008 did was it destroyed trust. It destroyed trust in institutions, in central banks and governments. And in many ways, what you see in the growth of ESG was a reflection of that loss of trust. Because what we're talking about is something that we used to vote for as citizens, and governments would pass rules and laws and regulations. But in many ways, we seem to have abandoned that responsibility and turned it over to the CEOs of companies. And I don't see how that is going to create the kind of change we want. I mean, ultimately, though, for change to happen, it's got to start with consumers, not with investors. And that's the other thing we're forgetting is so much of this was directing in the investing phase that many people abandoned their personal responsibilities for making the world a better place. They said, the way I describe it, this might be a little cynical, is you had people buying a venti cappuccino at Starbucks, going into work all day, coming back in the evening and buying an ESG fund in their SUVs, and coming back at 7 o'clock in the evening and buying an ESG fund. Say, look, we've been made whole again. The world is full of these things we're allowing people to do to make their guilt go away. I mean, the Jevons paradox, which has been widely talked about, is in full flow in this space where people do things to compensate for other things, and they think that that's going to be enough. But the fact that you recycle your plastics doesn't mean that the plastics go away. I mean, in a sense, if you're drinking 5 times as much and you're recycling your plastics, you might be doing more damage than not recycling and drinking only one drink a month. So I think in many ways, by giving people this easy way out, we might have reduced the kind of change that we'd have needed to see for this to actually work out at the consumer level. So I think we need to return that decision-making process to investors and consumers, and they have to feel the need. And that's a tougher sales pitch. That's why people prefer to sell to institutional investors, right? It's easy because you can use the right words, you can read scoring mechanisms, getting people to do the right thing at home. Now, set your temperature at 75, not at 68. In the summer is inconvenient, and people don't want to be inconvenienced. That's the harsh truth we're discovering around the world, where you can take Canada, you can take Europe. You're seeing that even in parts of the world where we thought people had bought into clean energy and a better planet, that at the voter level, there's still very much there's resistance to the kind of change that'll cause inconvenience to people. And I think that's a much tougher sales pitch, but that's a sales pitch we need to return to get people to do this at the personal level. And if they don't, then see if you can do it through the democratic system, through voting, through elections, through parties that'll actually do the right thing. But that'll be tough if people really don't want to bear the inconvenience of having to do the right thing and want it done by companies and other big institutions. I don't think it's going to succeed.
Coming back to the role of investors, I mean, I have a lot of sympathy with your point of view on the centrality of democracy and politics here. But if we come back to the role of investors, if we take an issue like climate change, although there's clearly a spectrum of opinion about how big an issue climate change is, it seems to me that it's at least not unreasonable to be worried about its long-term impacts on society and on the economy and on financial markets. And so, if you are an asset owner with long-term liabilities like a pension fund, you could consider yourself as having a financial interest in society avoiding runaway climate change. And again, that seems not unreasonable to me. So feel free to disagree with the premise, but if you agree with the premise that it's at least not unreasonable position for an asset owner to take, how should they think about investing in a way that supports the objective of limiting climate change?
I think the first is transparency. If that is your objective, you need to bring the people whose money you're managing as a pension fund into the conversation. You can't say, look, I know more than you, so I'm going to tell you what needs to be done, because it's other people's money. The second is we need to be less black and white about what we're investing in. We can't make it investing. I mean, I work at a university. University endowment funds are notorious for knocking entire sectors out. You cannot invest in fossil fuel stocks. You can invest in green energy stocks. I don't think that's a way, even if you truly believe that this is part of your mission to take care of the planet and climate change. That's not the way to do it, because in a sense, if you buy into the research that's building up, that gray, investing in gray spaces is actually better than green spaces, I might want you as a pension fund manager to invest in clean coal mining companies as opposed to dirty coal mining companies, and tell me the price you're paying for doing that. My guess is you'll get people going along much more if you're willing to bring them into the conversation and talk about what you're trying to do and what it's costing you, and being willing to revisit what you're doing if it's not working. I think that's the key, is you cannot make this, I use the word theocratic trifecta intentionally. You cannot make this a religion of good and bad, things you can do and things you cannot do. We don't know what works. Let's be quite honest, even in the clean energy space. Much as people like to say solar power is the answer for the future, when we really don't know what's really going to be the replacement for fossil fuel. And in a sense, the more we allow people to experiment with different ways of getting to that space, the better off we are, rather than putting them in a rigid path of these are the good people, these are the bad people, this is impact investing, this is not impact investing. No, and that's part of the reason I think the scoring systems have actually done more harm than good. Sustained analytics might be well intentioned, But the minute you attach a score to something, you're making subjective judgments on what matters and what doesn't. And I'm okay with that. But then you create gaming around it.
Mm,
When people complain about greenwashing, my point is that's a feature, not a bug of a scoring system.
mm,
Every time you create a scoring system, you get gaming of the system. And in fact, at some point, the gaming will become the end game for the players rather than actually doing what you're trying to do with the score. I mean, I've seen this with business schools. Business schools 40 years ago didn't have rankings. I remember Business Week in the early 1980s started its first business school ranking system. Well intentioned because they wanted students to be well informed. They said, we're going to look at things that business schools do and we're going to bring it into a score. It's taken on a life of its own.
mm,
I know big decisions that business schools now make which are directed by what it will do to their score rather than whether it's good for the school or good for education in the first place.
mm.
The nature, I can understand the incentive to have a scoring system. I think in corporate governance, we've had this issue, and I think many of the ESG scorers will learn by looking at what's happened in corporate governance where we introduce scoring systems. I remember when it started in the late 90s, early part of this century, when people said, well, if we can create a corporate governance score based on research, it's going to make corporate governance so much better. 25 years later, my question is, what has it changed? I mean, I see corporate governance scores all the time, but in my view, corporate governance has not advanced, even though the scoring mechanisms suggest that they have. People have learned to play the game, and the same thing happens when you have scoring systems to the ESG and sustainability.
I'd like to zoom out from sustainable investing to sustainability more generally. And in your article, The Siren Song of Sustainability, the theocratic trifecta's third leg, you finish off with the question, can sustainability be saved? And you make 5 recommendations there. And I think the first 2 of these we've already covered quite extensively. And that's about being clear-eyed about the limitations of what can be achieved at the business level and be open to the costs of business meeting sustainability goals. But I'd like to explore the next 2 with you. Be clear about who bears the costs of the trade-offs that inevitably exist, and be honest about cost sharing. Can you just explain what you mean by these?
I mean, I think we saw this with the Canadian carbon tax debate that's been occurring for the last 2 years, which is again with the best of intentions. Governments impose carbon taxes, saying carbon taxes are necessary because fossil fuels are making climate change worse. I'm willing to accept that as a fact. But the question is, if you impose carbon taxes, people who live in cities who drive electric cars, who don't have to drive 50 miles in a tractor or work in a factory, might not bear that cost. I think for the last 20 to 25 years, we've created these costs that ultimately get borne by the people who are least capable of bearing it, factory workers, lower income people. And I think that we have, and that's part of why we've seen a voter backlash against many of this, is people feel talked down to. They said, look, you talk about climate change sitting in your New York and London offices, but we're bearing the cost in the factory in the Midwest or a farm in Iowa. So I think that we told them it'll all be okay. We're saving the world, so you should be okay with it. And I think they're tired of hearing that. I think this again is this long-term issue. When do we start to see the benefits? So I think that the reality is anytime you want change that is good change, there will be a cost to society. And the question is, how do you make sure that that cost is not borne by the people who are least capable of bearing it?
Yeah, I think that does also reinforce the importance of putting the political process right at the center of all of this.
Ultimately, that is the issue, right? There is a
Yeah,
political component to this that you can't run away from,
yeah,
right? Much as ESG, I mean, I feel some sympathy for them. In the US, they're in if you're in the ESG space or the system, you're in the middle of a political firestorm right now. In Europe, you're starting to see the same effects.
mm,
And I sympathize with them, but I think it comes with the territory, and that's why acting like you're surprised by it is, I think, you got to accept that this is part of the game, and you got to be willing to make the political arguments as well in addition to the virtue arguments, we make the world a better place argument.
You finish that article by saying that above all, we need to drain the gravy train. And I quote, "The path to making sustainability matter has to start by removing the grifters, many masquerading as academics and experts from the space." And now, as someone who has the title Director of the Initiative in Sustainable Finance within a newly established Global School of Sustainability at LSE, I could be forgiven for thinking you might be talking about people like me. And I do think that the role of business in investing in relation to sustainability questions is a valid area of academic inquiry. But what would your advice be for people like me who are working in the field? What do we need to do to avoid being grifters? And how do we make sure that we do the work in a way that contributes to finding better ways forward, as opposed to just adding to the problems?
I think that it's, I didn't mean to put everybody into that space,
No,
but
I
I do think that, as I said, over the last decade, the salespeople and the grifters have essentially driven the space. So I think people like you and Andrew King, and I mean, I'm familiar, a lot of good people working in this space need to kind of, because when I do it, I'm viewed as an outsider. So I'm not going to be successful in pushing, because some of the research in this area is not just horrendously bad, but it borders on academic fraud. To start my discussion of sustainability, because I'm not in the space, I read the 10 highest impact sustainability papers out there. And you've probably seen all of them. The names are all recognizable names. I was truly horrified by what passed for research in the space. It either came from ignorance about business, and there were financial measures thrown out there, or they knew what they were doing and they decided to do it anyway. And that's, and for a long time, if you were writing, when I wrote my first piece on ESG, when I called myself a moral troglodyte in 2019, I looked for research that pushed back. There was almost no research. In the last 5 years, that's of course been filled in. But I think we need to fill the space with people pushing back. Make this a truly academic space, academic in the best sense of the word, where every idea has to be treated on its merits, rather than said, this is a virtuous idea, therefore we're not going to push back on it because it's got to be allowed to go through. Because that's why we're in the space we are, because I think for a while, if you had a virtuous idea, it got published and you did not get the pushback because it was viewed as not the right thing to do. So I think that we need more people like you. And Tariq Fancy, as you might have read some of his work. He used to work at BlackRock. He left and he talked. There are a lot of truth tellers in this space. And I think that that's healthy for the space. I look forward to seeing more debate within the space about, hey, we can't let this go by. This is not right.
Well, Professor Damodaran, thanks for making your contribution to us pushing back and getting some clarity and honesty into this debate. Really appreciate you taking the time with me today. It's been a fascinating conversation.
Thank you very much.